well. And obviously, it's a busy time, even though the markets technically south of the border are closed today in observance of Martin Luther King Jr. Day, Donald Trump being sworn in for a second term. My next guest says the first 100 days will be very intense, but he remains bullish on the markets. Joining us here in studios, James Thorne, Chief Market Strategist at Wellington-Altus Private Wealth. Nice to see you, sir.
Nice to see you.
And what an interesting time. I mean, you have the markets that I guess technically are hitting the pause button for the day, but all market participants arguably are watching what happens in Washington. Set the stage as a longtime strategist on how you're viewing this moment and where it might take us.
Well, first off, it's Washington's my old hometown, so it's people cannot. I cannot understate the amount of partying that's going on there,
Okay.
which is great, and the turnover. But look, I think what we have to do with Mr. Trump is take him seriously, but don't take him literally. And you can see that today with the tariffs. And I think what you're seeing in the United States is the fact that we need to get energy prices down. They are in a technology war with China. Productivity growth is the way we're going to get out of it. And so what we're going to do, and you know, it was with Mr. Bissett's testimony, the new Secretary of the Treasury last week came in and basically said, look, we need productivity growth, right? And so we need productivity growth. We need, 3 million more barrels a day of oil. We need real GDP at 3%, his sort of three arrows anchoring off of Abe. So we sit there and say to our clients at Wellington is, look, Trump is going to anchor his performance as a president off of the S&P 500 and Bitcoin this time around. So we're very constructive on the markets, and we would expect interest rates to drop dramatically over the next year.
Well, there's a lot to unpack there, but there's plenty of connective tissue to all of it. Let's just start with what is being buzzed about on tariffs, because we literally, I mean, technically we still don't know if day one brings across the board tariffs, but now there's some pretty solid reporting out there that there might be something that takes a slightly different shape. And I remember when a lot of the economists, even at Bloomberg, were trying to sort of paint a picture for what the global economic impact from tariffs might be this year, even they were projecting out if there is a targeted approach to tariffs, it's not as if the economy sort of globally falls off a cliff. And certainly Canada is hoping that there could be a window for a conversation here as opposed to wham, bam, 25%, thank you very much, tariffs. So how are you thinking about that subject specifically, just as sort of a starting point as an investor? How you think about the tariff part?
So first off, tariffs aren't inflationary. A change in relative prices is not a change in the general prices. That's first. And you're starting to hear some Fed officials finally come out and say that.
Because people, because there was a strong argument that that was going to be a highly inflationary force.
It is, and it's wrong. That's if you would answer that on your third-year macro test at back at university, you would have failed, right? So, but let's go to the next step. Look, we've been writing about this for a while. Trump wants to go back to where the United States was in the 1800s, and he's anchoring off of Alexander Hamilton. Bissett even talked about this in his testimony. They look at tariffs for a couple things. One is to protect industries, and two, to generate revenue. And then Mr. Trump adds a third leg to the stool, which is for negotiation. Think of Canada. So we would suggest that it would be a gradual process in terms of the United States increasing tariffs. And if they did it gradually, then it will not be inflationary. And I think when you listen to the new Treasury Secretary, that's what they're going to do. So I wouldn't be surprised about that. What I think we in Canada need to do is recognize the fact that our largest trading partner is going through massive structural adjustments. Stop being so adversarial and try to figure out how we as a country and as an economy are going to participate in this new growth. Just like Paul Martin Sr. in the early 60s went down to Texas and talked to Lyndon Johnson about the auto pact. We have not, our integration has actually gotten less over the last couple of decades rather than more. And we've got to basically wake up and smell the coffee on that.
It's been so unique to watch as well. Who steps forward for Canada when obviously there's a lot of very significant uncertainty in Ottawa, at least in the short term, and so we've obviously seen a bevy of provincial leaders and federal leaders who are taking the stand on that. Interest rates was something else you talked about, and it sounded like you're expecting that we'll continue to see a reduction in interest rates. Can you walk us through how the interest rate story plays out for you? I guess if you don't see tariffs as an inflationary force, then that would suggest that you think the inflation trends are reasonably good right now?
Yes.
Okay.
If you look at, we're in the part of time, we are in the cycle, part of the cycle where the Fed rate hikes and last year the Bank of Canada rate hikes were the largest contributor to inflation. So let's just take that out. When you do, we don't have an inflation problem. Let's look at the job numbers in the United States. If you look at the recent BLS job numbers, what you'll find is that you've got massive seasonal adjustments. John, one of the big lessons that I learned out of the 9/11 event was when the Bureau of Labor Statistics tries to take seasonal adjustments and adjust them for exogenous shocks, you get massive downward revisions. And so what I would suggest to you is that, and the Fed, Waller came out last week, Goolsbee came out last week, and Williams also came out, but basically saying we are pretty close to achieving our dual mandate. And if that's the case, then where they should be is what's called R star, which is the natural rate, which is 275. So where I'm at is I think what Tiff Macklin is doing is absolutely the correct move. Let's get down to the natural rate. It's 275, 3, wherever, we don't really know, and pause and evaluate. So I think the Americans are the Fed's going to do exactly the same thing and start to back end and start to cut rates. We are looking at significant downward revisions in the labor market data. If you look at the non-seasonally adjusted numbers, full-time jobs in the United States last month declined by 350,000. And Bissett talked about that again. So here's what I'm doing. I'm trying to read the room. Kid from Scarborough, right? Read the room in the cafeteria. When you have these important people start to talk about it, you pay attention. So I think the Fed's going to take rates down to R star, the natural rate. I think they're going to continue the normalization process. I think the data is going to flow the way that they want it to. And the question that we have for portfolio managers or your clients or your viewers is how interest rate sensitive do you want to make your portfolio? And do you want to basically game what we think is going to happen over the next 5 to 6 quarters?